The history of business is filled with both remarkable successes and notable failures, which offer important lessons for leaders today. Famous cases like Enron's accounting scandal and Kodak's failure to adapt to digital technology highlight how companies can falter. In the fast-paced world shaped by AI and global uncertainties, understanding why big companies fail is vital for survival. Failures rarely happen overnight, they often result from slow declines caused by poor strategy, short-sighted financial decisions, or outdated company culture. By analyzing these failures closely, businesses can create systems that don't just resist challenges but actually grow stronger because of them. Learning from failure helps companies spot early warning signs like drops in cash flow or market share, build stronger operational processes, foster a culture where employees feel safe to raise concerns, and make smarter choices about when to stop investing in projects that aren't working, avoiding costly traps. These insights give businesses a valuable edge that success stories alone can't provide. One effective way to learn from potential failures is to use a pre-mortem technique, where before starting a major project, the leadership team imagines the project has already failed 3 years from now and works backward to identify what could have gone wrong. This approach helps reveal risks that might be overlooked due to optimism. Alongside this, conducting a financial statement review is essential, beginning with a qualitative look at the income statement to understand revenue trends, costs, and profitability, the balance sheet to evaluate asset quality, capital structure, and liquidity, and the cash flow statement to analyze cash generation, investments, and financing activities. These reviews set the stage for detailed ratio analysis, starting with profitability ratios such as gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity, which highlight how well a company uses its resources to generate earnings. Strong profitability generally indicates good cost control, pricing strategy, and operational efficiency, all key to sustainability. Liquidity ratios, like the current ratio, then measure the company's ability to cover short-term liabilities, helping to assess financial health and resilience. This combination of forward-looking risk assessment and thorough financial analysis provides a structured way to anticipate problems and strengthen strategic decisions. Liquidity ratios like the quick ratio and cash ratio are important because they show whether a business has enough liquid assets to cover its short-term obligations. Maintaining adequate liquidity is crucial to keep operations running smoothly and to boost confidence among stakeholders, especially when economic conditions are uncertain. Efficiency ratios, such as inventory turnover, receivables turnover, payables turnover, and total asset turnover, help us understand how well a company uses its assets. High efficiency ratios are a sign of disciplined management and good asset use, which in turn supports profitability and healthy cash flow. Solvency ratios look at the bigger picture of a company's long-term financial health and its risk exposure. Key solvency ratios like the debt-to-equity ratio, debt ratio, and interest coverage ratio show how much leverage a company is carrying. Finding the right balance is key. Too much debt can make a company vulnerable during tough times, while moderate leverage can support growth. Finally, cash flow ratios are gaining more attention because they focus on the actual cash a business generates and uses. Metrics like operating cash flow ratio, free cash flow, and cash flow coverage ratios provide crucial insights into a company's financial flexibility and its ability to meet obligations from its day-to-day operations. These financial ratios help confirm whether reported profits truly result in cash flow, which is crucial for a company's long-term survival and ability to adapt strategically. Reviewing financial statements and ratios acts like an early warning system by highlighting warning signs long before a company collapses. By comparing the balance sheet and income statement, analysts can spot risks like liquidity traps, when a company's ability to cover short-term debts weakens, or excessive leverage shown by solvency ratios such as debt-to-equity. Tools like the Altman Z-score combine various ratios to forecast bankruptcy risk accurately. These analyses turn static numbers into a clear story of a firm's health, revealing red flags like aggressive revenue counting or high cash burn rates that often foreshadow failure. It's also important to regularly measure the gap between the strategy planned by the board and what actually happens on the ground, since misalignment here often leads to failure. For example, Kodak's downfall came from clinging too tightly to its profitable film business instead of embracing digital innovation, teaching us that businesses must sometimes disrupt themselves to survive. Lehman Brothers' 2008 collapse was caused by excessive borrowing and dependence on short-term funding, showing the critical need for maintaining liquidity buffers. Meanwhile, Blockbuster ignored the core job customers wanted done: easy movie watching, focusing instead on its stores and late fees, which ultimately cost them their market to Netflix. These cases illustrate how strategic and financial missteps can lead to corporate failure. Revenue models that unfairly burden customers tend to be unstable because they create resistance and dissatisfaction. When it comes to learning from failure, there are clear advantages and disadvantages. On the plus side, failure provides objective data that is less biased than success stories, which often overlook what went wrong. It's also a cost-effective way to gain wisdom since studying others' bankruptcies can prevent costly mistakes on your own. Additionally, failure sharpens decision-making by building a mental library of actions to avoid, helping you focus on strategies with higher chances of success. However, there are downsides too. Overanalyzing failures can cause paralysis by analysis, making firms overly cautious and missing real opportunities for growth. Also, a strategy that failed in one context, like a retail giant in 2010, might not apply to a different business or time, so it's important not to assume all failures are transferable. Lastly, focusing too much on what could go wrong can dampen morale and stifle the creative energy needed for innovation. Balancing these insights is key to using failure as a helpful learning tool without letting it hold you back. When companies fail, it often comes down to a few key categories. Strategic drift happens when a company doesn't adapt to new technologies or changing consumer habits, like Kodak, which invented digital imaging but stuck to film because it was more profitable. To overcome this, companies need to disrupt their own products before competitors do, a strategy called self-cannibalization. Liquidity crises arise when firms rely too much on short-term debt to finance long-term, hard-to-sell assets. Lehman Brothers is a prime example, collapsing due to high leverage and dependence on complex debt markets. Maintaining a strong cash reserve, or fortress balance sheet, helps companies survive financial shocks. Operational inertia is when a company's structure resists change, leading to high fixed costs and inefficiency, as seen with Nokia failing to shift from hardware to software. Embracing lean orchestration, or flexible cost models and decentralized decision-making, can counter this. Customer misalignment occurs when businesses profit from customer pain points, like Blockbuster's late fees, which drove users away to Netflix's more convenient model. Focusing on what the customer really needs, through the jobs-to-be-done approach, helps prevent this. Lastly, governance failure, such as lack of oversight or ethical problems, can lead to misleading financial reports and hidden debts, as with Enron. Radical transparency, including real-time AI auditing and independent boards, offers a way to avoid this pitfall. The biggest takeaway is that arrogance blinds companies to small changes that add up to major risks. Success lasts when firms treat their strategy as a living, evolving plan, keep enough cash on hand to navigate uncertainty, and stay humble enough to learn from past failures. In truth, failure isn't the opposite of success, it's one of the most honest teachers businesses will ever have.